Welcome back to another episode of the Pursuit of Profit pod. Today I'm joined by Brent Donnelly. Thank you for coming.
Sure. Hey, Joe, how you doing?
Yeah, I'm good. Can't complain. So, like I said, off camera, most of my audience are traders, retail guys based in the UK and Europe. I'm sure a lot of them have probably heard of you. I've spoken about your book previously, The Art of Currency Trading and Alpha Trader. But if you could just briefly introduce yourself for the guys that maybe don't know you.
Sure. So I'll try to keep it short because I've done a lot of stuff over the years, including retail trading my own account for 5 years. So I went to business school and I started on the spot desk at Citibank, trading FX. And that was in the 90s. And the business was just very different then. It was all about flow, and there was no like macro, there was no risk taking. And so I felt like it was kind of analogous to being a blackjack dealer. Like, say you love blackjack when you're like 16, 17, and then you go and be a blackjack dealer, and you're like, shoot, I'm not really making any decisions here. And like, I thought I loved blackjack, but I don't really love blackjack dealing. So,
Yeah.
and I've always had a creative streak. So I had written a movie script at that time, and I was very naive. So I quit and went home to Canada. I was in Sydney, New York at the time, and went back to Canada and tried to pursue like a screenwriting career. And at the same time, though, because I think deep down I knew it was a long shot, I also started day trading, and that was the NASDAQ bubble. So then from 98 to 03, I traded the NASDAQ bubble and made a lot of money. And then also the movie never got picked up, but I had a TV show that I was also writing, a cartoon, and that got picked up. So that was on TV in Canada. So that was fun. So that was a fun 5 years. And then a lot of the lessons actually, or many of the lessons in Alpha Trader, come from that day trading experience from 98 to 03, because it was like the best of times and the worst of times, as many traders probably went through from 2020 to 2023, in that you went from just like a crazy regime where it was like almost easy to make money to an almost impossible to make money regime from 98 to 2003. So we can talk about that after, but basically I took my account up and spent money and bought cars and had fun and all that for like 5 years. And then slowly started losing money in 02. And then my show got canceled. So then I was losing more money, and I was going to get married. So I was like, shoot, maybe I should get a real job here before the window closes. Because I had kept in touch with people that I had worked with and stuff. So I came back into trading more out of necessity at a bank. But then over time, it actually worked out well, because at that time was kind of when the flow started going to become more automated. So a lot of the smaller flows in FX started going through on machines. And then the role of the trader, of the market maker at a bank, became a lot more about risk taking. And eventually over time, I was also very customer facing. So like I wrote a daily note that went to like a lot of clients. And then I was just trading macro essentially at that point. So I loved it. And then so I went to Lehman, then a hedge fund for a few years. After Lehman went under, I went to a hedge fund for a few years. And then I've been working at various banks since then. And then in 2021, I moved over to a place called Spectra, which is, we cover hedge funds and banks in FX, but then also gives me the freedom to create a lot more content. So I write my daily still, but I can sell it. And so our clients get it, but then also I can sell it to other people, to retail and all that. And then also I have more flex to write what I want in my books, and write, I can criticize the Fed, or, be basically free from the shackles of compliance and all that kind of stuff. So, so mostly my career has been as a market maker, but like I said, really my passion has been a combination of risk taking, which is global macro kind of approach, and writing. I'm writing about it.
Got you. Okay, that's interesting about the TV show as well. I didn't.
Yeah, that was good times. Yeah, I actually learned a lot about that too. I feel like in the kind of part of my edge in writing about markets is that I kind of come at it from the point of view of like, I don't want this to be boring. Like there's a line obviously where it gets unprofessional and it gets stupid, but also you can still make it kind of interesting. I believe like value added from a market's perspective, but then also, you know, something that people want to click on and read because it's interesting.
Yeah, I've been following your 50 and 50 over the last year or so, and I like your writing style. You actually show a bit of personality, which is it's good. I've been enjoying it. Um, cool. So you started at City in the 90s, you said, is that right?
Yep, that's right. Yeah, 95. Yep.
How long would you say it took you to really grasp trading? Was it something you took to instantly, or did you struggle at the beginning?
No, so for me, I from the time I kind of grew up in the era of Wall Street, the movie, and Liar's Poker and that kind of thing. So really from the age of like 14 or 15, I was like, I want to be a trader, and that was my only goal in life. And so I had kind of was learning on my own, trading and losing money like in a stock account when I was a kid. And then the interesting thing for me was that I felt like I went to business school, I studied economics and business, and I felt like in the first like 2 months of working at Citi, I learned more about markets, like how markets really work, than I learned in 4 years of school. And I feel like, you know, my one complaint that I've always had hiring, because I've hired a lot of traders over the years, is that the analyst programs at the banks focus on the elite schools and the top students. And to me, intelligence is like the minimum bar, like it's necessary. You need some kind of basic quantitative skills to trade, but there's so much more to it that goes way beyond book smarts. I think it's a lot more to do with like, I don't want to say like X factor, but street smarts and understanding the game and the meta game and all that kind of stuff is a lot more important than just like raw test taking ability. So I always found it frustrating because by the time the pool came to me to select, I really was only choosing from like super quantitative people from the elite schools, and that's not necessarily, it can be, but it's not necessarily who succeeds as a trader. So to answer your question, I felt pretty comfortable almost right away. Like I kind of, I don't know, like I naively or got lucky or whatever, but I kind of felt like that's what I was in the world to do in a weird way, as useless as it may be in terms of we're not saving turtles on a beach or teaching kids how to read, but I kind of felt like that was my calling, and so I kind of jumped in and was pretty confident right away. The other thing too is working at a bank, you do have a lot of edge. So if you're not doing anything stupid, and you kind of understand what the game is working at a bank as a market maker, there's edge built in, and that's so it's easier. It's a lot easier than starting as a retail trader, because you just have that, you have the franchise, you have the information, you have like mentorship, you have people who you can learn from. So there's just a lot of advantages to starting at a bank, and I was able to kind of reap the rewards of those, or reap the benefits of working at a bank.
Yeah, that makes sense. You've always had a long career, right? 30 odd years you've been trading. And obviously there's periods of drawdown, you know, every strategy, every trader experiences maybe a bad year. Have you ever had a period where maybe you had a bad year and you thought about quitting? Maybe you thought, you know, this wasn't for you?
Oh, for sure. Yeah. So, I mean, in 02, 01, I guess it was 02 really. The Nasdaq went from fractions to decimalization, and I had a very specific strategy at the time. It's kind of meaningless now, but like, so I won't go into detail, but essentially I was listening to, there was an S&P pit still at that time. So I was listening to the pit on headphones, getting kind of an idea of what the balance was in the futures, and then capturing bid offer in the super retail stocks that had really wide bid offers. And so when I was there in like 1999, 2000, what you wanted was stocks that traded at a very high value, because then you didn't have to trade a lot of stocks. You didn't have, because there was commission in those days. You didn't have to pay a lot of commission. You wanted stocks that were trading like at $400. So I printed in the morning a list of all the stocks over $100, and it was like 4 pages long in 1999. And when I left, it was 4 stocks in 2003. There's only 4 stocks over $100 on the Nasdaq.
Yeah.
So at that time, I was always gross positive pretty much the whole time, but I was trading, I had to trade more and more shares to do the same thing. And I was kind of like, I didn't know what else to do. So I just kept on doing the same thing over and over until like my account was like a 45-degree line up, and then it was a 45-degree line going down. And at that time, I did contemplate quitting and just pursuing like a more artsy kind of like starving artist kind of thing. Um, but I do believe in like the freedom that money gives you has a lot of value. So I think people overestimate how much money can give you happiness, but it also does offer you a lot on, you know, from at least from 0 to X, and then it flattens out and you don't get a lot of marginal utility above X, depending on where you live and all that. So I thought, I think I'll be happier go like sticking with trading. So that was more of like an existential kind of decision, like what do I want to do with my life? But then in '07, there was this kind of like a carry bubble in FX. And to me, it seemed really obvious at that time that it was going to blow up. And it just took so long to blow up that like '07 was a horrible year for me because everything just kept on grinding higher. And in a market making seat, I was at Lehman Brothers at that time. In a market making seat, you don't usually lose money like over on a year. And I was kind of like oscillating around 0 for a lot of the year. And then I just got my head ripped off by a client on the last day of the year. And I had got all the way back up to being small positive at that point. And then I don't know, it was like a $700,000 loss on a single trade. And I this is an alpha trader, but I emailed my mom, Jesus. I emailed my wife and said, like, I don't think I can do this anymore. Like, this is just too demoralizing. And the only thing I think that saved me was, well, one, it was a new year, and at a bank, that's another good thing about a bank is that you always reset to 0 every year. So like, unless you get fired, even if you lose money in '07, you start '08 at 0. So that helped me. And then also I feel like getting kicked in the nuts enough times, you start to understand that the pain goes away. And so after a certain like that, at that point, I've been trading for whatever, a really long time, 20 years or whatever. I kind of, no matter how bad it feels, I kind of know, I knew at that point, okay, just don't think about it, go home, wait a couple of days. And like most emotions have a pretty short half-life. So by the time '08 started, you know, it's a new year, you're kind of more optimistic. And then '08 ended up being like the best year of my career. And it was an incredible year to trade in general. Like volatility was obviously through the roof. And then market making, you know, people were just doing whatever they had to do, and they weren't really, you know, arguing about a pip here and there. So it ended up being the right decision to just kind of hang on and grind. And I mean, I had a period like that when I worked at the hedge fund too. I feel like those periods get less difficult over time as well, because I've kept stats on my trading over many years. And so I kind of know like there's a lot of variance, right? Sometimes you lose money 7 days in a row. But if you've been trading for 2 years and you lose money 7 days in a row, you think, wow, I suck at trading. Whereas if you've been trading for like 14 years and you have spreadsheets going back 10 years, and you can see, okay, I lost money 7 days in a row, 9 other times over those years, then you kind of go, okay, well, my process isn't broken, so it's probably just variance. And that ability to distinguish between my, like, I don't have an edge, or like I'm emotionally screwed up, or like I suck at trading versus variance is very difficult when you're first starting. But as time goes on, it just gets easier. So I feel like now I can ride the down waves a lot easier. But the other thing that kind of comes out of that whole conversation is that like in '01, '02, what I was doing in 99, 98, 99, 2000, what I was doing had a ton of edge. Like I knew exactly what I was doing. I was making money almost every single day. And when I stopped making money, I knew that it wasn't working anymore, but I just wasn't aware enough or like smart enough to say, okay, this doesn't work. I got to find something different to do, or I got to like close my account. All I did was kept doing the same thing over and over till the money was going down, like till my equity was low enough that I was like, shoot, I guess I'm closing my account now. So now I kind of am able to also distinguish between, okay, the thing I'm doing doesn't really have an edge anymore, so I better kind of change courses. So it's not as depressing because I'm able to say, okay, like correlation trading was kind of my bread and butter for many years, and then it kind of stopped working. And so I would like say whatever year that was, say 2014 or something. I started out really bad, and then I'm like, okay, this feels a kind of like O2 felt, where no matter how hard I try and stick with my process and do everything in a rigorous way, I'm just not making money. So my edge is gone. And I was able to then say, okay, well, now what am I going to do instead of continuing to do the same thing over and over? And I think that's like a mistake that a lot of people made that I talked to on the retail side in like 2021, 2022, was it was a specific regime. Volatility was high. You know, you could buy Zoom calls through earnings and 10x your money if you were lucky. And, you know, there were certain things that worked really well. Or like if you're in crypto and you knew the drops and you could buy the NFTs and flip them for 10x and all that kind of stuff. And at a certain point, that all that stuff just stopped working, but people didn't know what else to do. And so I think like the thing you have to, that kind of speaks to the idea of adaptation and admitting when you don't have an edge and then finding a new edge. And then also whatever your edge is now, be looking for other sources of edge. So like if I'm good at macro, I'm still always trying to develop systematic things that will make sense, that can maybe produce a little bit of alpha on the side, but then also contribute to new ideas. So then I see, oh, this systematic thing inspires me to look at something else. And then I'm like, oh shit, there's a whole other source of edge over here. And so ideally, you're not just doing one thing really well, which is like what I was doing in 2000. You're kind of running like a few different businesses, and those businesses all have a little bit of edge. And then if one of them stops working, you're not dead.
Yeah, I think that's an interesting topic that I want to dive into a little bit more, you know, on generating alpha and having an edge in your process. At what point do you have a kind of framework that helps you decide when you need to change something? Because a lot of trading systems will have a period of drawdown of a month, 2 months, maybe a quarter. How do you know if it's just a period of drawdown or if actually you need to change something and, you know, there's no longer alpha here, you no longer have an edge in the market with that process?
Do you mean systematic or discretionary?
I guess both, because people watching this, some will be systematic and some will be discretionary.
Yeah, so for me, everything always has a discretionary component. So if I develop a systematic strategy and trade it systematically, there's still some logic behind it. Like, say this is a really simple thing, like buying dollar yen in New York time and being short in Asia time has generally worked for like many years overall as a system. And I know why that works. It's because corporates buy dollars in New York time, and most of those corporates are US or based in California or New York. And so there's just more demand for dollars in New York time. And that's like an empirical thing. It's not like some huge secret. And as a market maker or in my seat now, I'll know if corporates stop buying dollars, or if they start saying like, oh, you know what, everyone's doing it in New York, so I'm going to start doing it in Asia. I would just know that that's happening because I have a view of the market and I talk to people. So then I would know, okay, whatever this model's, even if it's at over earning, I better tweak it down because I can see the behavior that's driving the systematic alpha has changed. So generally, like I'm also not a good enough quant to just backtest and know that I'm not data mining or snooping around for and optimizing or over optimizing parameters and stuff like that. So whenever I backtest, I always have a theory. I backtest it, and then it either is right or it's not, like scientific method, right? Like when you go to the science fair and you have, oh, I don't know if you have the science fair in the UK, but whatever that is, like hypothesis testing, analysis, that's all I do. So I won't go in and like try to optimize parameters and that kind of thing. I'll just say like, okay, I think when RSI of oil is below 15, that only happens like once every 3 years. That's insane. That should be bullish. And then I'll test it. And I won't then say like, okay, that didn't work, but let me try 9 in RSI, or let me try 6 or whatever, you know, like I won't tweak the parameters, because generally what I've found is that you can find stuff that works the more you tweak it. It's like p hacking in social sciences, right? You can eventually you'll find the answer that you want, but it probably won't work out of sample. So generally what I try to do is find a hypothesis. Ideally, it's something where I have like an actual explanation flow wise or logic wise, like some of the intraday things you can say, like gold producers tend to hedge, at the fix. So let me test how gold trades around the fix or whatever, those kind of things. And then the ultimate thing that tells you it's not working is the P&L, because if you're running the same process and the P&L is not working, now, like you said, the question is then, like, at what point do you listen to the P&L, or what point is it just a normal drawdown? And usually for my things, if there's a drawdown, then I'll start sniffing around and try to figure out why. And a lot of times you can kind of figure it out. Like it could be something as simple that you didn't think about, like with that dollar yen thing that I said, that the Japanese current account flipped, and the net, like when oil was going up at 100, 120, it didn't work because the importers were buying dollar yen every day in Asia. So it wasn't working anymore. And if I didn't kind of think of that, which like I may or may not have, then the P&L would basically be telling me, hey, dude, like look into this because maybe something's wrong. And if I looked into it and I couldn't find anything, then my base case would be that it's variance, or it's just normal drawdown. But I mean, this is not an easy question to answer. Like the systematic hedge funds are always trying to, do you reduce risk when you're over earning, or does that mean that the model's like on fire and you want to double down? It's kind of like the hot hand. It relates a lot to the strategy. But ideally, like I said, anything I'm doing has some kind of logical framework behind it. And then so if it's not making money, then I try to analyze the framework. And like the correlation example that I said, I mean, the simple example was that, or the simple reason was, it worked really well because nobody was doing it from like 02 to 08. And then after 08, everyone understood how correlation trading works. And like every single blog was an overlay of Aussie versus copper. And a lot of algorithms then became tuned to like 50 by 50 correlation matrix, looking for what's cheap and what's expensive and that kind of thing. So again, in that instance, the P&L kind of told me that like, hey, this isn't working. And all I had to do was kind of sit back and think about it. And it was like, yeah, I guess this thing doesn't work anymore, and it's probably never going to work again.
Yeah, I guess it's a hard thing to admit though, right? Like you said, when you've been making money for
It
4 or 5 years.
it's really hard. Yeah, because it's like a, I don't know, it's like a friend at that point, right? Like that thing, like also because I'm writing about these things, it's kind of like I became the correlation guy. Like I was finding new correlations and writing about them. And that was like not part of my brand, but it was like part of my story of how I formulated my trades and stuff like that. So yeah, it's tough to give it up. I do still use intermarket correlation as an input, but what I find is it's good as one of several inputs, and then you find like 3 or 4 other things, like whatever, similar to seasonality, or similar to positioning. I find most of those things don't work on their own, but when you have a combination of like 6 of those things that you like to follow, and they're all kind of giving you the same signal, then that's when for me, that's when the trades come together, is multi-factor, kind of all pointing in the same direction. And in contrast to that, sometimes like right now, the yield setup is bearish yields, bullish bonds in July is like a thing. But then when I go and I look at everything else, I'm not really convinced that that's the trade. So like the seasonality kind of gave me the idea to look at it. Then I looked at a bunch of other stuff, and then I was like, yeah, I don't really like that. So that's usually my process, is one of like, say, 6 or 7 different paradigms, or not paradigms, but like factors will flash on one of my screens or a spreadsheet or whatever. And then that will attract me to something, and then I'll look into it more deeply. And then, most of the time it's like, yeah, there's nothing here, but sometimes there is something there.
Got you. So on your process now, what's your kind of approach? How do you kind of, create your trade ideas? So you spoke about, seasonality, might be able to identify a trade. Can you elaborate a bit more on your kind of process now?
Yeah, so now I find, and I think this is like kind of for me has become the answer to the edge problem, is not having one factor dominate. Like a lot of times I was using one specific factor at various times, or not like one factor, but like one main strategy. And now what I do is more like there's a universe of factors like positioning, technicals, narrative is like the big thing that I think I have the most edge in, just because of like experience and because I have a really big network. I have a good idea of what the dominant narratives are and what's priced in beyond just looking at like, what's priced into Fed funds or whatever, but actually what's priced into like in currencies and stuff like that. Where are people leaning and what are the expectations? So a lot of my initial ideas come from narrative in terms of like everyone's been bullish euro. This is just an example, like a random example, but like everyone's been bullish euro for a while. And then I do some work on German CPI and I see like based on Belgian CPI and whatever, some other country that have already come out that, it's like 70-30 German CPI is going to be weak. And everyone's set up long euros for the past 3 weeks. People have been buying. So that's like a really good 2-day trade to be short euros through German CPI. I mean, that was a real trade that I did. I put it on Twitter and whatever. So those kind of things are like because what I generally do is like I look at macro as the current price is the sum of all the information in the world. And then my edge is interpreting new information or anticipating the new information that may come and the skew of that new information, and then trying to get ahead of it. And then my time horizon ends up being like 2 to 10 days generally. Like I don't, even though I'm looking at global macro, my trading time horizon is much shorter, or sometimes even just like intraday through a number or whatever. So that's kind of what I'm looking for, is like mini inflection points in the narrative, or the like kind of finding the weak side kind of stuff. But then on top of that, I'm trying to use like cross market correlation and technicals and a bunch of other stuff to then filter out like, okay, is this a good trade or is this a bad trade? So like, if I can get in, there's a quadruple top in euro at 111, and I know like there's a ton of gamma and there's like 2 billion euros in options expiring at 111 in the next 2 days, and euros trading 110.60, and German CPI is coming out tomorrow, and I think it's going to be weak, then I know I can be short euros with like a 50-point stop. And so like that's kind of how it would all come together, as opposed to like from 02 to 07, or actually 08 as well. Basically, I was just looking at what all the other markets were doing and looking for dislocation. So yields are ripping and dollar yen hasn't gone up yet, I buy dollar yen. And like it was literally that simple. For 5 years you could do that. And in a way that's what I was doing with S&Ps as well. But now there's just so many algorithms doing that now for me that's an input. So like if I was bullish dollar yen anyway for 3 other reasons, and then yields go from 372 to 379 and dollar yen hasn't moved, then I'd be like, okay, that's my trigger. Now I'm going to be long dollar yen. But if I was just like sitting here and yields went up 5 basis points in 2003, I would have bought dollar yen on that. And now I wouldn't, because I would think that is already a trade that the algos have already done.
Yeah. So it sounds like you mostly trade FX. Is that still the case, or?
Yeah, I mean, I feel like that's where my edge is. I feel like everything else that I trade is kind of like when I worked at the hedge fund. So I traded FX other than the 5 years of equities. I traded FX my whole life otherwise. And when I got to the hedge fund, I could trade anything, right? I could trade futures and everything. And generally what I found was that I didn't lose money, but I wasn't really making consistent money in the other stuff. But I learned a lot of useful things about other markets that then made me a better FX trader. That's kind of how I see it, is that like by actually participating in those markets, you start to learn more like, okay, NYMEX close is a huge moment for oil, and the moves at that time tend to be very flow driven and tend to mean revert or whatever. I would probably never have known that unless I was, punting oil and then seeing those huge moves and asking questions about them and then finding out what was going on. So the other thing I find with non-FX is that the one advantage of those that I have in those things is that I'm very selective. So I barely ever trade them. And generally I overtrade, and because of like stimulation and boredom and gambling and all that kind of stuff. So that's a weakness for me in FX. but it doesn't tend to be a weakness for me in other things. So like when I finally do a trade in gold, the EV of those trades actually tends to be higher, but I just don't do them very often.
Got you. And how much do technicals play a part in the process? So you obviously create the idea. Well, how much do you do on the technicals?
So I feel like techs are a really good risk management tool and not a good trade selection tool. So I've kind of come at this like from various angles over my career, but I just have seen so many traders now and so much evidence, like academic evidence and all that, that the patterns that people watch generally are not predictive. Like if you back test head and shoulders or whatever, it's not predictive. But then the funny thing is, like, the more time I spent in markets, the more I gravitated towards simpler techs. And the reason is I think the simpler things reflect an underlying reality in the market a lot of the time. Whereas if you start getting into like GAN fans and 61.8 Fibonacci's and stuff like that, there may be some validity on some level, like as you know, markets as an organic system and all that. I kind of believe some of that. But if you know, say dollar yen keeps on bouncing off 143, a lot of times it's simply because like there's a corporation that's trying to buy $2 billion yen, and they left an order with a bank saying between 143 and 143.1, buy $2 billion yen over the next 3 days. And it's just that simple. And that's why it's bouncing.
Yeah.
And I think that's like Peter Brandt's thing too, is that horizontal lines are just, there's no discretion. They're very often reflecting a reality. Sometimes it's like protection of an exotic option, or I mean, in stocks too, a lot of times it's just like Fidelity wants to sell 2 million Microsoft at 185. And so they're there. And that, I mean, they're not always that obvious about it, but they're kind of around there. Excuse me. And so I tend to find that the more simple stuff is, I just find it more appealing logically because I think it's reflecting something real. And then also, I find the good thing about simple things like horizontal lines is that you can fine tune pretty close. So like you can establish a pretty narrow band of where you want to get in. And the more, you know, the better your fine tuning is, the more leverage you can have and the bigger position you can have. And also the faster, you know, if you're right or wrong, which is nice if you're impatient. So my philosophy is essentially like, I never select a trade based on technicals. I'll always use it as a filtering and risk management tool. So my ideas will come from all those things that I said, and then I'll go to the chart and then I'll say like, okay, I want to be long whatever, but you know, it's in the middle of the range. So there's no sense being long here, because if I, you know, I don't see any catalyst in the next 48 hours. So I'd rather just take advantage of the random bid offer drift or random drift and put my bid somewhere down by the bottom of the range. And so pretty simplistic stuff generally. Although I do try to incorporate other stuff into my technicals, like options and stuff, because generally, like when there's a preponderance of strikes, if you know the market, you can kind of generally, most of the time it means people are long gamma at those areas, not always, but generally. So if you take like, okay, you do basic kind of technical analysis, then you say, okay, what are the big strikes over the next like 72 hours? You can do a few other things that kind of layer on. And then also if you talk to people, you just listen to what people are talking about, or even if you like subscribe to services, you know, if 5 services all have 110.25 as a level, it's more likely that that's an important level than if one person does. I mean, just that's kind of like the self-fulfilling prophecy aspect. And also you can kind of visualize, okay, if everyone's looking at this level, what's the order book going to look like? Well, it's probably going to be bids above and stops below. And then you can also then kind of formulate your tactics around that and try to think like one derivative away from that and go like, okay, if that breaks, everyone's going to stop out here. So I either want to like put my stop another half day's range below that, or if I'm super patient, which I'm not usually, but if I'm super patient, I want to buy when the stops happen, or wait for the stops to happen and for it to recover and then buy, or something like that. So I'm trying to kind of incorporate like basic technicals, like looking at the charts, but then overlaying some kind of rational view of what's the actual order flow is going to look like, or the order book's going to look like when we get there.
Got you. Okay. And you spoke a bit about position sizing there. What's your risk appetite like, or what would you recommend people risk per trade? You know, I hear so many different opinions on this, but are you more of a vanilla trader? You keep the risk tight, or do you like to risk a little bit more?
So I feel like the standard, like textbook 2-3% of free capital kind of stuff makes sense. The only way I deviate is that when I have money in the bank, and there's a really good opportunity, I will tend to go way off the textbook in those situations. Like, say you're working at a bank and you want to make $5 million in the year, and you're up 3 in March, you're up 3 million in March. Then that would be a moment where, like, if I saw something that I really, really loved, I might risk like $1 million on that trade, thinking that, like, if I make 2, then I'm at 5, and it gives me, like, that's how you get the momentum. Is kind of, it's like, it's a tricky topic because it's can also sound a lot like when you're at the casino and you got a lot of black chips, start betting huge. But there's a difference, because like your expected value at a casino is negative, and what you're trying to do as a trader is find the moments when the EV is positive. And if you're good, then you can probably identify, those moments. I feel like I'm pretty good at, like, I know it when I see it in terms of like the probability and expected value. The issue that I have is that I don't wait for those moments enough, so I end up doing a lot of like low EV or negative EV trades out of boredom and things like that. So like that's my big weakness. But I do feel like I know it when I see it generally, and then those are times when, basically, to answer your question, I'm very tight when I'm like around flat or down, and then the more I get away from the zero bound, the more I tend to get, like, not loose all the time, because that's just bad. Like, that's the house money effect, where you're like winner's tilt, where you're just happy and you're like, then you end up blowing all your cash and going back to zero. But if you can do it in a like, if you can maintain rationality and be like, okay, I'm up a lot here, and this is like a really good opportunity. I'm going to risk like a quarter of my year-to-date P&L, even though on Jan 1 or at 0 P&L, that would probably seem like an insane amount of money relative to your free capital. I feel like that's the way that you get, essentially, then your P&L can be like a call option, where you're tight on the downside, and so you're essentially like spending premium, but then you have like the right tail on the upside if things are going well. But like I said, it's a very fine line between seeing a really strong opportunity and oversizing your bet because you're doing well, and being really happy that you're doing so well and gambling because you're excited. And like, that's a very fine line.
Yeah, I think a lot of traders, once they make a bit of profit, they think, oh, I've got money to play with now. And then they take
Yeah.
the less favorable setups. But I guess what you're saying is, when you see the more favorable setups, know that you've got more money to play with and you can kind of double down on those. Is that right?
Yeah, I mean, that's exactly it, right? Is that like, if you sounds like you probably play blackjack, but like, if the dealer's showing a 6, and then you want to split, and whether you're having a good time or a bad time shouldn't matter, but it just, the thing is, it does, because there's path dependence. So you just can't bet as big when you're down or when you're flat. The only time you can bet big is when you're in a strong position capital wise, but you only want to do that when the dealer's showing a 6 and then you're splitting aces or whatever. I mean,
Yeah.
I actually don't know optimal blackjack strategy, but that's, you get the point.
I mean, that's as good as it gets.
Yeah, I think so, but I'm not sure. So I just didn't want to create a huge series of bad comments there. So but like I said, I think actually one thing that is really good for me is when I'm over earning, like in my spreadsheet, I have like a conditional formatting that shows like you're over earning based on, depending on what my capital is in that. And what works really well for me is actually squaring up at that moment, instead of, because otherwise what happens is, like, the momentum of the positive momentum keeps you going bigger, and you're getting bigger, and you're more excited, and you're happier, and you're overconfident. And then usually what happens is, like, I blow up in some form, like, not blow up my whole account, but like a mini blow up kind of thing. Whereas if I square up and then I let that sit for like 12, 24, 48 hours, and then I'm kind of like resetting to that new level of capital and P&L, and then saying, okay, I'm just going to sit here for as long as I possibly can. Like, I'm going to sit on my hands. I'm going to close my trader cockpit, like freaking unplug my keypad, as you know what I mean? And then eventually you're like, okay, this is the one, I got to do it. And then you do it. That's when I'm in a good frame. And when I'm in a bad frame, I'm just like what you said, I'm up a lot, and then I spunk half of it because I just got excited and overconfident.
Yeah. In the art of currency trading, you spoke about characteristics of a good trader. Uh, what do you think? So for the viewers, what do you think are the characteristics somebody needs to, really do well in this game?
Yeah, so I did a lot of work on that because I find it a super interesting topic. So in Alpha Trader, I kind of did a bunch of research on success outside of trading and then trying to relate it to trading. And then obviously having had a lot of traders work for me. One surprising thing that isn't all that critical that I found is risk appetite. Weirdly, I like, because I have a very high risk appetite, I kind of assumed like all traders that wanted to trade would just be all these people that came in with this raging risk appetite. But actually, many of the traders that worked for me were fundamentally risk averse, surprisingly. And most of them like wouldn't admit it or take a while to admit it. But I think that's totally fine because you can have rules-based kind of risk management that says like, okay, on my trades, I'm going to allocate this, I'm going to stick to the plan, etc. So I just thought that was interesting that the more I studied and thought about it, that risk appetite actually isn't like the number one thing. I think the number one thing is the ability to be rational, because all the stuff that is bad and that like all the biases that Kahneman and Tversky talk about and all the things that everyone does wrong, almost all of them come from some form of irrational behavior, right? Like you trade differently because you're up, because you're excited. You get trigger shy because you're down. Like what you want to be able to do is have a process that's somewhat robotic. And like I don't think you have to necessarily, it's impossible to just be a robot. So that I think is totally flawed because it's not possible. But what I think you want to be able to do is get to the point where you're seeing your own emotions in real time. And like that's kind of the point where I felt like I moved up, like I leveled up trading wise, was I didn't like stop doing stupid shit all the time, but I could see myself doing it. Like sometimes I would even say to someone like sitting next to me, I'm bullish and I'm short right now. I have no idea how I got short. And then, that's like a level of awareness where you, instead of convincing yourself, because what I would have done like 8 years before that was like somehow convince myself that it was going down because of, like confirmation bias, and I'd
Yeah.
find some bearish narrative. So the ability to not necessarily like always be rational, but to override your own irrationality. Like it's kind of like the system one and system two thinking. Like system one is like your lizard brain and your instincts and all that, which can be good. And they can be like the amalgamation of all the things, and they can be pattern recognition, but they can also be emotions and bias and a lot of bad stuff. So the ability to kind of be able to step outside yourself and see yourself making mistakes. And like in a word, that's rationality, right? Like being rational, especially when, if you look at like how did Renaissance, like Jim Simons make all that money, most of the dislocations and inefficiencies in the markets come from the group as a whole being irrational, right? Being FOMO and greed and panic and all those things are like the really big opportunities in a lot of markets, micro and macro, come from those moments of irrational behavior by the group. Because like the wisdom of crowds generally is pretty good, but if the incentives or the emotions and all that aren't aligned, suddenly the wisdom of the crowds goes away temporarily, but it always comes back. So the ability to be rational, and to follow a process, and like that's kind of discipline is lumped in there as well, because like if you're doing things that aren't part of your process, you're being irrational, like, and so I think that's the number one thing. I think there is some element of like, I think courage is a bit too big of a word, but like that the ability, either through just rational like spreadsheeting, because like if you're risk averse, you can do this with a spreadsheet that just tells you, okay, this is a 5-star trade, you should be risking $300,000 on it, and you have the courage to follow the spreadsheet because you believe in your process. So however you want to describe that, but some kind of courage. And then I think there's still like an aspect of conscientiousness, hard work. That's the other trait I feel like that's really important. Simply because there's so much information, like for my approach, but I think generally for most people, the way that you get trade ideas, the way that you find an edge is by being attentive, by being curious, and by being conscientious and paying attention, coming in, reading the central bank speeches, like whatever the thing is for your market. But like just simply doing the work is an edge. Like a lot of people are just lazy and want to make money, but don't really want to do the work.
Yeah.
And so like, I think that's fundamentally how most people are, and probably including myself. But the ability to kind of like do the work when you don't feel like it, and do the research and do the back testing, and knowing that like most back tests come up empty and you got to look, through the haystack to find the needle and all that. I feel like that's a really important characteristic, as well as just the ability to like do the work and to grind and to take the punches and come in every day and lose money 4 days in a row, and on that fifth day to still be rational and not like trading with a lump in your throat or trying to make your money back and all that. It's hard, right? Like it's
Yeah.
hard to maintain rationality through all those emotions, whether they're good or bad, and excitement and all that stuff. So yeah, so I guess that, I don't know if those were three things. I think rationality, conscientiousness, and like courage, I would say,
Courage.
are the three things. Because one thing like in 2008, just on the courage thing, was it was kind of scary. Like the shit was hitting the fan every single day. We thought some of the banks, I mean, Lehman did go under where I
Yeah.
work. Banks were going under. It was scary. Like it was legitimately scary. And there was basically two types of traders. Like half the people or three-quarters of the people just went under the desk and played defense. And then 25% of the people, or whatever, some percentage of the people were like, okay, this is the time to make crazy amounts of money because everything's flying around. And like obviously 2008 was like a once in a lifetime, but the ability to trade in fast markets, like fast markets is what usually when you make the most money. But it's scary, like sometimes your drawdowns are scary. Sometimes the things are moving in ways that you don't fully understand, or like things are gapping and all that. Those times are always the best times to make money. And so the ability to like be uncomfortable and scared in a controlled way, because it's kind of like driving a race car is scary, but like you don't want to just be like woohoo and crash into the wall. You have to be kind of able to be scared, but then also have a framework that means you're not going to crash into the wall. And I think for me, when I lose money, or even if I lose a lot of money, or I get smoked on a client thing or whatever, it never really bothers me. The only thing that really bothers me is when I don't follow my process and then I feel like I'm a little bit out of control. That's like a different kind of scary. So that's the bad scary. And then the good scary should be like, wow, this stock's moving 25 bucks every day and it used to move 3, and like I'm trying to catch the turns or whatever. Like that can be scary, but you're doing it, you're still using proper risk management and all that, and proper position sizing. So you're kind of scared, but deep down, that you're under control.
Yeah, I remember in 2020, March 2020, when Ethereum dropped below $100, and I'd said previously, if ETH drops below this level, I'll load up. And I didn't buy it below 100, but when it got back above 100, I was buying, but it still felt wrong, right? But it turned out to be one of the best trades I've
Yeah.
ever
So
done.
that's the thing, is that like I said, there's two different kinds of scary. One is like I'm out of control and I'm gonna blow up. That's bad. But the other kind of scary is like, holy shit, I've never seen this thing move this much,
Yeah,
and I want to buy it here, but I'm scared. And then you press the buy button because it's the right thing to do. That's like, those are the, like you said, those are the best trades. Is the thing that's really hard to do, and generally nobody's doing it. That's by definition, you've reached some point of market inefficiency where everyone's selling because they're scared or because they have to, and
yeah,
you're the person buying, and that's hard. It's hard to do.
absolutely. Coming on to macro quickly, obviously, like you said earlier, 2020, 2021, we saw a ton of easing. We saw a lot of capital injected into markets. It was, markets on easy mode. Anyone could have made money. Last year, we saw the Fed tightening. It became a lot harder to make money in the markets. What are your kind of views on macro had a minute, how do you kind of see things playing out? Where do you see the dollar? Where do you see the S&P over the next, say, 6 months to a year?
Yeah, so like I could answer that, but honestly, I don't trade on that time horizon, and I generally just don't think on that time horizon because like I'll do my best if a client is trying to hedge some 8-month exposure or something, I'll do my best to kind of come up with a view. But I would say honestly, like the more long term that I think like that, and the more I have like a core view or a long-term view, the worse I trade, because essentially what you're doing is like you're cutting off half the distribution of trades that you can do. So if you're like core bear stocks, which people tend to be a lot, which like empirically is a bad thing to hold as a long-term view, then it just becomes way too hard to be long. And if your time horizon's 3 to 10 days, any product that you trade, I know I'm not answering your question,
It's all right.
but any product you trade can go up or down in the next 3 to 10 days. And so I just find like I sometimes will have the same view for 2 or 3 months, and trade around it. But it's more because like upon continuous reassessment, I still think that's a good view. But I would never sit here on like in June and say like, okay, I think S&Ps are going to 5,000, so I'm going to be long, and I'm going to be long till December. It's just not what I do. And I don't know. I feel philosophically, I feel like markets are kind of like weather, in terms of like it's a very complex system. Your starting point and determines like what you see for the next whatever, say 10 days. And then as you go each step in the process and you create the Monte Carlo tree or whatever, there's just, by the time you get to December 2023, to me, I think it's impossible to forecast. Like maybe somebody can do it, but also if you read like super forecasting or any kind of analysis of humans trying to forecast longer term, the track record is not good.
Yeah.
So like I said, I mean, it's impossible to kind of not have some views that are just lingering there in your head. But I think just as a matter of like speaking honestly, I don't really hold views that are long term, and I don't trade them either.
Yeah, no, fair enough. I understand this is the internet as well, right? If you say S&P is going to 5,000, you'll get guys in your Twitter replies saying, you said S&P to 5,000.
Yeah, you know what? Actually, that's a funny thing because I couldn't really go on Twitter when I was at banks. So my whole Twitter experience has been like the last 2 years. And I find it funny when someone says, like, say I post something and it's wrong, and someone's like, haha, like idiot, or puts a clown emoji or whatever. I'm like, clearly that person does not trade, because like, of course I'm wrong. Like 50% of the time I'm going to be wrong. And like, I have 25 spreadsheets that show that. So like, dude, you're not hurting my feelings. I know I'm wrong half the time. So the question is like, do you monetize the other half at a ratio that's a bit large enough to make money, right? So um I've that's actually, I think, a strength that I've gained from writing and publishing, because like so many people read my stuff that it just doesn't really hurt to be wrong anymore. Like I just like sometimes I'll write a whole piece about why I was wrong yesterday and what the whole why the trade was wrong. And I always get a lot of emails saying like, wow, like I can't believe nobody ever says they're wrong and stuff like that. And to me, I just think it's part of trading. Like it just doesn't mean anything. Of course you're going to be wrong. Like, so it doesn't bother me at all being wrong. What bothers me only is when I don't follow my process, and then like I was supposed to lose 35 grand on the trade and I lost 72 because I kept moving my stop and all that kind of stuff. That to me is bad trading. Being wrong is just like nobody bats above 55-60% in trading, and my thing going back many years is basically 50-50 on my trades. So the important thing is you got to make a lot more money on your wins, obviously, than on your losses. Or some people can get to like 58-60% win rate, but not me.
I think it also depends on the risk to reward, right? I see a lot of guys in the retail niche now, they target this huge R. So they'll go for, 1 to 10 trades, and they might have to lose 10 trades in a row, but they have these huge winners. I think, psychologically it can affect you a lot, having 10 losses in a row so frequently, still being able to pull the trigger, right?
Yeah, for sure. And I think one, again, like I kind of mentioned this, but one thing that really helps, like say that was your ratio, is if you do it for 3 years and you have a spreadsheet that shows you like, okay, this is my hit rate is 18%, but I made money last year, then you start to just become less emotional, or like it doesn't really impact you emotionally or psychologically as much, because you understand what your ratio is and then you're performing at that ratio, and that's fine. And so I think like having a lot of data offers you some immunity to the pain of losses. Like after a while, like years of collecting the spreadsheets and knowing I lose money half the days, how do you walk out of the office and get really upset that you lost money? Like you're losing money half the days.
Yeah.
You can't, it's just too exhausting to be mad at yourself that much. So I I kind of reached a point at some point where I just had like a more deep understanding that losing money is part of it, and that's fine. What's not fine is losing more than your process like describes.
Yeah, absolutely. Well, I'm conscious of time, but this has been a super interesting conversation. I really appreciate you coming on. How can people find you?
The easiest way is to go to spectramarkets.com, and Spectra with an A, or I'm on Twitter. Everything kind of links through there, and most of what I'm talking about I try to put on Twitter.
Okay, brilliant. Well, thank you again. I really appreciate your time.
Sure, yeah, thank you.
Cheers, Brent. Take care.
Cheers.